Hey, what's up guys, it's Jonathan here. We just got the Consumer Price Index report for February, and it has some interesting things in it that I wanted to discuss. So let's discuss that, and let's also talk about the Fed and kind of what to expect from the FOMC meeting for next week. So for the headline number, we got a reading of 0.4% for the month-over-month number, and a 6.0% for the year-over-year number, which were both in line with expectations. And then for the core numbers, we're expecting to get a 0.4% reading on the month-over-month, and we actually got a 0.5% reading. So very close to expectations. And then for the year-over-year number, we did hit expectations at 5.5%. So the interesting thing about this report is that the increase for shelter for the month of February made up almost 70% of the increase for the overall headline month-over-month number. And this is good because we know that shelter inflation, like I've talked about on multiple of my previous videos, that we are starting to see shelter inflation start to move to the downside. And we're seeing that from many different leading indicators, whether that's data from Zillow, data from Redfin, data, pretty much you can pull up data anywhere when it comes to rents and housing prices, and you could pretty much see that we are on a downtrend. And as well, and not only shelter is on a downtrend, but also our year-over-year numbers that we are getting on inflation. So the year-over-year numbers for the headline number has been on a downtrend since June of last year, whereas the core numbers have been on a downtrend since September. And this report only continues that trend to the downside. So very good news there. Moving on to sectors, we did see that energy actually came down quite a bit as well. Last month we had energy at 2%, and this month we have it at negative 0.6%. And this is some of the reason why we look at core numbers, because we know that food and energy can be very volatile sectors. So it is good that we are seeing energy come down as a whole, especially given how much of a vital importance that makes in our entire economy. Now, something else that was really interesting about this report was what's going on with car prices. So with the new car prices, we saw it go up 0.2% for the month of February, which is a exact copy of what we saw in January. But when it comes to used cars, this is where it gets really interesting. Last month, we got a reading of negative 1.9%. This month, we got a reading of negative 2.8%, which is only showing that used car prices are starting to accelerate their downturn, which is really interesting because a lot of the market likes to use the Manheim Used Car Index to try to predict what we're going to see with used cars in the CPI reports. But one thing that we are starting to see is that we have seen the Manheim Index move up over the past couple months, while the CPI data is showing us that it's moving down over those past same months as well. And this was a question that was brought up on Twitter by a very popular Twitter account called Zero Hedge. And when he prompted this question on Twitter, it was answered by a very prominent auto market person on Twitter called the Car Dealership Guy. And basically the way he explained it is that Manheim tracks the auctions and how much cars are going for at auction, whereas JD Power tracks how much people are actually paying for the used cars. And pretty much his explanation was that dealerships are paying a lot more money for cars at auction, but then when they take those cars and they try to sell it to consumers, they're having to sell it at a much lower price, pretty much taking almost a loss on every car that they're selling. And pretty much what dealerships are trying to do is they're trying to make money by selling additional things like warranties and stuff like that. He also went on to pretty much say that JD Power numbers haven't caught up yet. Now, I personally don't really believe that this is true. I think that what's going on is that the interest rate environment we're in is starting to put a lot of downwards pressure on car prices and on what people can afford for cars. And because of that, it's causing the sales price for cars to come down. And something else that I think that backs up the point that I'm making, we're seeing a lot of deflation in used car prices, but we're not seeing that same deflation in new car prices. And the reason why is because with new car prices, usually they're financed by in-house financiers. Let's say you go Honda, you want to buy a car from Honda, a brand new car. They will actually use their in-house service, Honda Financial Services, to give you a below market rate on your financing. And pretty much what they do is they'll actually take a haircut on the loss. So they'll pay the difference between the rate that you're supposed to get on market and the rate that they end up giving you, just to get you to buy the new car. So that is probably why we're seeing this discrepancy. And I think that it's only going to get worse, especially as the Fed has talked about keeping rates at a higher level for a much longer time. But we'll talk about the Fed later on in this video. So when it comes to shelter, like I said, it did make up almost 70% of the increase that we did see in the CPI report for February. The index for rent rose about 8% for February, whereas the owner's equivalent rent increased about 0.7%. And then lodging away from home has increased 2.3% for the month of February, which is a pretty significant increase, but it's not really too far off the norm of what we've been seeing over the past couple of readings. So when it comes to shelter, like I said, it did make up almost 70% of the increase that we did see in the CPI report for February. The index for rent rose about 8% for February, whereas the owner's equivalent rent increased about 0.7%. And then lodging away from home has increased 2.3% for the month of February, which is a pretty significant increase, but it's not really too far off the norm of what we've been seeing over the past couple of readings. And as I said before, we do have a lot of leading indicators that are telling us that housing prices and rents are starting to come down. So hopefully soon the CPI report will start to reflect that as well. And even the Federal Reserve has said that as well, that they do expect shelter to start coming down too. So when it comes to travel, we did see the airline fares increase 6% month over month, which was a pretty significant increase. And also, it's a reversal from what we've seen over the past 4 months, where we've actually seen declines in airline fares. And we've also saw a decrease in the medical care index of about 0.5% for the month of February, which is also another good sign that we are starting to get more broad-based disinflation. So for some interesting data that we got from the CPI report, eggs were down negative 6.7% for the month of February, whereas lettuce was also down 6.1% for the month of February. And when it comes to eggs, we do remember that we did have that massive spike in egg costs, and it is a good thing that we are seeing it start to revert back down. And we also saw a really interesting spike in the cost of women's dresses, where women's dresses went up almost 13% for the month of February. So moving on to the future and looking forward, you guys probably already know about what happened with Silicon Valley Bank. And I think that because of what happened with Silicon Valley Bank and the fact that we are starting to see some distress in the markets, I think that the Federal Reserve will probably have to start looking at their future rate hikes. Personally, I think that if the Federal Reserve was still very concerned about the wage price spiral and inflation getting out of hand, I don't necessarily think they would have agreed to bail out Silicon Valley Bank. I think they would have just let the depositors take the haircut, or I should say that they wouldn't have bailed out the depositors of Silicon Valley Bank. I think that they would have just let the depositors have to take a haircut on whatever they did, and whatever fallout was from that situation, they would just let it be. But I think that the fact that the Federal Reserve did step in is a good sign that they're very confident that we may be turning the corner on inflation. It was very tricky the past week because we went from a Jay Powell talking about possible 50 basis point hike to now reversing, bailing out Silicon Valley Bank. And now we have a lot of banks on Wall Street now talking about the possibility of not even having a hike next week. Now, even though I think that there's a better chance that we'll get a pause or a 0 basis point hike, versus a 50 basis point hike is like night and day difference, I actually still think that the 25 basis point hike is still the most probable. I think the reason for this is because we did still get somewhat a semi-hot CPI read. Luckily, this one was somewhat kind of boring, I'll be honest with you. But that boringness does also give more confidence to the Fed that they can go with the 25 basis point hike. Now, moving forward from that, I know before the Silicon Valley Bank situation, the market expected that the Fed will do 2 more 25 basis point hikes before they pause. I think now, given the fact that technically even though like a lot of the banks like Silvergate and Signature and Silicon Valley Bank had very questionable operating practices, I think that this still is the Fed's sign that they did break something in the economy. And really the wider belief on Wall Street is that the Fed was just going to keep going until they break something. And now since they've broken something, I actually believe that the possibility of us having a Fed pause after they hike next week is much higher than it was before. So really, for me, in terms of investments, how am I treating it? For me, I'm really just looking to kind of get rid of all of my cash before the next FOMC meeting after the one next week. I think that will give us enough time to really assess what's going on throughout the broader economy. And hopefully I can get rid of my cash. If not, I still do have a HELOC open up at like, I think 8 or 9%. So I'm kind of motivated to pay that off too. So for me personally, I kind of have like an either or. I have like an out either way, whether the market skyrockets and leaves me behind, then I'll just take that money and put it in my HELOC. If the market stays flat or even gets more pain off of different news or something like that, then I'll have money to buy the dip. So that's basically all I got for you guys. Thank you so much for watching. As always, please like, share, and subscribe. And I'll see you in the next video. Peace.